Hello and welcome to the LP Financial Services Forex training class, Introduction to Fundamental Analysis videos. In Lesson 3, we'll discuss technical analysis versus fundamental analysis. When we look at the definitions for each, we see that fundamental analysis is a strategic assessment of where a currency should be traded based upon any criteria except the movement of the currency's price itself. These criteria often include the economic conditions of the country and the currency that that country represents, its monetary policy, and other fundamental elements. Technical analysis is a method of predicting price movements and future market trends by studying price charts of past market action. Technical analysts only take into account the previous price of a financial instrument and, where available, the volume of trading and open interest in the trading instruments. When we look at the main differences between technical analysis and fundamental analysis, we see that fundamental analysis uses various factors that influence supply and demand to predict future currency price movements. Technical analysis uses charts of previous currency price changes to predict the future currency price movements. Another big difference between technical analysis and fundamental analysis is a relationship of cause and effect. Fundamental analysis looks at the causes of currency change. Technical analysis looks at the effects. Fundamental analysis causes, such as government policy, can later be seen in the technical analysis charts, which constitute the effects of a certain policy. Another main difference is the types of analysts. Fundamental investors would research a currency from top to bottom, looking at interest rates, balance of trade, gross domestic product, unemployment levels, and other important economic factors in order to see if a certain currency is about to rise or drop in value. Technical investors, on the other hand, would look at the price action of the Forex trading market and view chart details such as the open, high, low, close, and use technical studies for the currency price of a certain time to notice changes in the momentum in the direction of a specific currency. Fundamental analysis is more suited for longer-term Forex forecasting, while technical analysis is more widely used to predict short-term changes in the Forex trading market. When we look at using both technical analysis and fundamental analysis together, we're using a strategy called combination analysis. This is the most recommended method of foreign exchange trading, is to use both fundamental and technical analysis together. In this way, you study the fundamental analysis of a currency and find out what economic, political, and other factors may impact the future direction of a currency. Next, you turn to technical analysis and study the currency charts, trying to find the right trading signal to enter into the market in order to buy or sell a specific currency. After you're comfortable using both types of analysis, you can be sure you are covered both ways. Now you can turn to the foreign exchange market with the confidence that you know what currency to trade with and when to trade as well. This will conclude Lesson 3, Technical Analysis versus Fundamental Analysis. In our next video, Lesson 4, we'll go over the various major economic indicators that have an influence on the foreign exchange market.